Good morning, ladies and gentlemen. It's very nice to welcome you here. Thank you for coming. We gathered here to discuss PGE second quarter results that we published early this morning. A quick information for our internet viewers. We are sitting here in front of analysts and investors in Warsaw in PGE offices. Please let me introduce you to our speakers today. Mr. Marek Woszczyk, President of the Board and CEO, and Ms. Magdalena Bartoś, CFO.
Good morning.
My name is Jakub Frejlich, I'm the Head of Investor Relations. Our speakers today will give the presentation and will be ready to answer your questions afterwards. Now I will hand over to Mr. Marek Woszczyk. Please, Mr. President, the floor is yours.
Thank you very much, Kuba. Good morning, everybody. I'm very glad to have you once again here in our headquarters. This is our regular job we do after each quarter. And so anyway, it's very good to have an opportunity to update you on the second quarter results and key conclusions, key takeaways. But at the beginning, I would like to stress that recent half a year was indeed full of developments, in particular including the update of our strategy. A lot has already been said, so my intention is not to repeat what's been said in the mid of the May. Looking at your faces, most of you were hearing what we were to say on our update of the strategy. Today, we will focus on the business results and some regulatory aspects, some regulatory issues that were affecting the energy market as a whole and our company itself. First, I will comment on the key takeaways of the last quarter. We'll go through the investment update and regulations, as I said, that affected company. And then I will hand it over to Magda that will get you through more detailed information on our financial and operational results. We will finish the presentation with updated outlook of what we believe should be expected in the coming months. Of course, after the presentation, as Kuba has said, we will be ready to answer your questions. So going to more concrete information. On the slide you may see some highlights of the first half of this year and last quarter. So the results we published show that the current year is a year shifting market conditions. That in a consequence creates some challenges in the utility business, if I may say so. However, our results confirm that a company can go through this transition period with healthy margins. As you may see, our EBITDA was close to 3 billion. However, it was impacted by some number of non-recurring items. When we stripped them off, then adjusted recurring EBITDA amounts to 1.4 billion after the quarter two. Of course, in a consequence, net profits attributable to the holders, to the stakeholders, amounts to 1.7 billion. In terms of the cost management, this is a very important part of our job, of the management job. We spend a lot of time to maintain the cost at, let's say, appropriate level. We informed the market, we informed you when we published our strategy that we want to be not only the leader of the market in the generation segment, but as well the leader in terms of the operations. So we put a lot of stress on achieving the operational excellence. We continue as a whole group to restructure our workforce and we do this through the voluntary leave programs, and they proved to deliver the results. When we adjust already paid out compensations from the voluntary leave program, our labor cost appears to remain flat during the first half of this year, of course, compared to the first half of the previous year. We managed to realize the hard coal prices at lower level than we expected. And we are on track with our savings program, which we outlined in our strategy update in May. In terms of our investment commitments, we go ahead with our investments as planned. So in July, we signed an EPC contract for the Turów unit, 460 megawatts. We continue large modernization project in Bełchatów plant, as well as we continue investments in the renewable segments, namely wind farms assets are on track. In terms of the external financing, we already informed the market widely about our latest achievement in that field, but just to remind it, we reached out to the international debt markets to secure the financing for our investments. So PGE established a 2 billion euro bond program. We started with a 500 million euro public issue that met with a huge demand. The offer was over 8 times oversubscribed, with a total 300 investors interested in. So we're happy to have such a very good situation and such a good confidence in PGE. Besides of that, in May and June, our investment grade ratings were confirmed. So both the company and the issued bonds, so we maintain a stable outlook as we promised to do when we published our strategy. The next slide gives you a picture of our operational performance, which is in line with our expectations. So our net generation from our asset fleet was above 13 terawatt hours. So the volume of production reflects actual availability and performance of our fleet after significant decommissionings that we made last years actually. In particular, I mean Turów, I mean Dolna Odra, and I mean the mothballed units, gas-fueled units in Rzeszów and Lublin in particular. Besides of that, we continue the huge program of modernizations of the existing plants that also has an impact of our volume of the produced electricity. Distribution volume was higher in the second quarter actually, by 1% if you compare year on year. Volumes sold to end users was higher by 8% when we compared it to last year. We do this within the frame of, let's say, the country's economy that is performing pretty well. This is my personal judgment. The real GDP growth of 3.4% in the first half of the year, we see a significant improvement when compared to last year, which of course led us to think in a positive way what we may expect in the future in terms of, for example, consumption or the development of the dynamics of the consumption of the electricity. However, due to the mild winter dynamics of the electricity consumption is hampered after July, anyway, after the July data, we saw a positive growth of 0.2% year to date. So the same situation we witnessed last year, so this is nothing new from our perspective. We expect that the consumption may slightly continue. The next slide gives you a picture of our main investments. So taking into consideration the number of investment projects PGE is involved, we think that quick update on the timelines and developments in that field is crucial. So let me start with our flagship investments like Opole 2, when we construct 2 new hard coal-fired units. Everything is on the schedule so far. Currently works are concentrating on the site preparation and excavation works. In terms of Turów, there's a lignite-fired unit of 460 megawatt of a capacity, net capacity. We signed in July EPC contract. The agreement allows us to issue notice to proceed by the end of this year, and we plan to do so. In Gorzów, when we built a gas-fired cogeneration unit, works has commenced. We continue the retrofit program of Bełchatów units. So units 11 and 12 are in progress, and we expect to complete the modernization in the coming year. Last year, 2 units were completed, namely 7 and 8. Further 2 units, namely 9 and 10, are to be completed in 2016. So in total completion of retrofits will increase capacity by 120 megawatts in Bełchatów. We also are proceeding, as I mentioned, with the renewables investment as planned. Current portfolio of the realized projects includes in total 246 megawatts. We also informed about that in May. So we commissioned Wojciechowo wind farm of 28 megawatts of capacity. Next wind farm in Karwice, construction has already been started. We signed the contracts for Lotnisko, where we plan to construct 90 megawatts of a capacity. Construction is to be completed in 2015, so next year. And we have 2 further wind farm projects, but they are at the tendering process. I mean Resko 2 and Kisielice 2. But as I said, timeline is according to the schedule. But by the way, you can see the timeline on the right side of the slide that reflects expected projects delivery. Well, in terms of the regulatory developments that impact business, energy business, as you know, the world of utilities is full of regulation. So personally, I have nothing against it. As long as it is under control. So here I permit myself to present a choice of regulatory issues that impacted business in the first half of this year most. So first, to start with the environment protection and the carbon allowances scheme. Finally, after the administrative decisions were made on the governmental level, allowances for 2013, so last year, generation were granted in April this year. What is important to outline is that PGE provided investment of a significant value that basically secure allowances for this year and the coming year generation. Secondly, capacity mechanism is in place. As of January, operational reserve mechanism was introduced. The picture of the market is that this mechanism indeed restored stability to the system, providing at the same time for a certain investment incentives. Further changes are expected from 2016, when a cold reserve is expected to be in place. I'm only mentioning the existing tools, mechanisms that are already in place, offered by the TSO. However, the community, I mean the industry, PGE together with our, let's say, competitors, but the other companies acting on it or running the same kind of the business, we are working on a common approach to the capacity market. We already said a lot about it. There is some small delay in the schedule because we thought that we will publish the final result of our work under the umbrella of PGE, Polish Association of the Electricity Generators, before the holiday period, but we plan to do so in the mid of the next month. I mean, in the mid of September, we should be ready to open a public consultation on what we propose on the final shape of the final structure, final model of the Polish capacity market. Cogeneration support was introduced in May, you know that, and this will affect generators even before a heating season starts. Well, this is a short-term perspective of this regulation because the Parliament has decided to restore the support mechanism for the cogeneration only until 2018. It's very difficult from today's perspective to say anything more on that. Will it be changed? Will it last longer, reaching beyond 2018? Anyway, such a regulatory decision inevitably affects investment-making decisions on the investor side. At the same time, we are witnessing the tight supply of the certificates from the renewable sources, I mean green certificates, as well as ongoing discussion on the future shape of the regulations for the renewable resources. Maybe I will come back later to that item, but just to briefly say what I may say, we expect that probably Parliament will speed up with the works on the new RES law, just to deliver, let's say, the final results. Impossible, cannot be. I have a full of people here in front of me. Okay. Last, from the most important regulatory impacts is, of course, LTC compensation scheme. You probably know that recently PGE updated its compensations model due to updated assumptions for the discount rate of a final adjustment. So in August, PGE, very nice music, okay. In August, PGE has received the annual adjustment decision from the regulatory office for 2013, and I'm happy to say that this application was verified in line with our expectations. So the outlook for further years of long-term contract compensations, we believe, should remain predictable. And that is all at this moment from my part. Now I'll hand over, as promised, to Magda, who will take you through the results in a more concrete way.
Thank you, Marek. Hello, good morning, everyone again. Welcome to our presentation, and let me guide you through some more details on the financials and operations of the second quarter and first half of 2014. Our reported results for 2014 are grounded in two, let's say. One is the regulatory developments that Marek has just run you briefly through, and the other is operational results. As we discussed in our last year's year-end presentation, 2014 proves to be a year of a very difficult market environment when we need to consume, or when we have to consume, the lowest historically electricity prices, and when environment remains truly complex. Group revenues for the quarter came at 7.3 billion and remained flat to last year's comparables. We noted on a comparable basis, on recurring basis, we noted roughly 800 million drop, and the decrease is mainly due to lower realized price of electricity and production output. Group's EBITDA reached 2.9 billion, increasing 36%, however impacted by significant one-off items. When excluding those, in totally amounting 1.5 billion, we will itemize them later on, our EBITDA dropped by 1/3 and penalized by a decrease in power prices and lower supply profitability. With net profits associated to shareholders, those one-offs managed or allowed us to compensate for the unfavorable market scenario, and that made our earnings per share grow and reach 0.92 zloty per share. Our balance sheet confirms financial strength of PGE. We closed June, our end of June net cash position is 2 billion. We keep our word stated in the strategy. We invest in our assets, in our conventional generation fleet, our generation assets and distribution assets. Our capex reached 1.2 billion, growing more than 40% when compared to last year's capex of the same period. Our cash flow generated from operations is stressed by weak operating results, and also includes an impact of a prepayment made to our coal supplier. That, on a comparable basis, so excluding the effect of the prepayment, our cash flow from operation essentially equals the change in cash flow from operating activities, essentially equals to the change of EBITDA on comparable basis. With the recent bond issuance that Marek also mentioned in the outlook, in the headlines, we also confirmed our stable investment grade ratings. We keep our promise to make our investors feel as comfortable as it can be with our financial strengths and balance sheet and cash flow operations. Our EBITDA was largely marked by a number of key developments on the regulatory side that impacted our results. The growth in EBITDA, as said, 36% growth in EBITDA includes a 1.5 billion effect of the one-offs. As we mentioned in our last presentation, PGE was granted with CO2 allowances. We received those on our accounts in April, and that allowed us to recognize a gain of 887 million, in total reflecting 2013 CO2 allowances and the first quarter of 2014 allowances. A lot has happened on the long-term contracts compensation front. As with previous periods results, we accounted for expected 2014 compensations. Second quarter of 2014 compensation estimate was 120 million. We account for those on a pro rata basis, so with roughly 250 million of the first half of the year compensation accounted for, we expect to add a similar amount in the second half of the year. Court verdicts also came to our favor and allowed us to release roughly 250 million of provisions. As we often mentioned in our presentations, long-term contracts compensations are quite a complex piece of legal art in Poland, and that requires us to adopt some assumptions that might change. And we also reviewed in the last quarter our compensation model, following with the recent decisions of the President of the Regulatory Office to one of our peers, that made us update our calculations and recognize an additional benefit of 911 million related to the final compensation estimate. So as we might be aware, we've got annual compensations of long-term contracts, but that is being followed by an estimate of a final compensation that we will be accounting for in 2017. And with this update, we changed our assumptions related to discount rate and booked additional revenue of more than 900 million. Another significant change to our To our assumptions that also has got an impact on our earnings is the discount rate used to calculate the present value of long-term provisions. Two groups of those provisions were updated with the discount rate. That is land restoration provision in our conventional generation segment and long-term employee benefits provisions. With the dropping price, with the dropping cost of money and decreasing yield of state treasuries, we unwinded more than 600 million of provisions. The discount rate we applied to this recalculation is 3.5%. If this discount, if the state treasury's profitability remains stable until the end of the year, we will not be having any change with this respect in the second half of the year. As we operate in a complex and difficult market environment, one of the key pillars of the strategy we recently updated is to deliver efficiencies and sustainable savings. Marek has already mentioned in the highlights that the first half of 2014 was busy with the managerial work being done on the efficiencies and savings. In the first half of the year, we updated our savings targets. We defined a set of those managerial actions and projects to get there and realized close to 150 million savings, with majority of those being recurring, sustainable add-on to our EBIT. Our optimization programs are not only limited to headcount reductions, but also focus on asset utilization and operations redesign, in particular in conventional generation business line, in distribution and renewables generation. Electricity production output in Q2 reached 13.1 terawatt hours, down by 3% to last year's figures. The decline in volumes produced mainly regarded our lignite fleet. The lignite fleet production output was down by 10%, as our Turów Unit 10 was decommissioned, we mentioned, and our Bełchatów Jumbo Unit 858 megawatt unit was down due to repairs. A balanced portfolio of assets, though, allowed us to manage the down production on lignite and compensate for that drop on our production on hard coal. That is even despite one decommissioning in our Dolna Odra plant. Biomass co-combustion and wind generation were strong drivers behind our renewables renewables growth. We produced 0.6 terawatt hours on renewables, with biomass co-combustion improving on economics and profitability and adding to the volumes we added to wind farms generation. We continue to manage our fleet responding to market needs. Lignite assets availability was down. That is consistent to our previous message of refurbishments in our Bełchatów plant and Turów decommissioning. That will deliver more efficient use of our assets in the future, especially in Bełchatów plant. Our wind assets keep high availability with load factor of 27%, and we continue to improve managing not only the generation assets but also distribution grid. Our network losses ratio is in downward trend, and we keep our word to reduce interruption times. There is a strong managerial focus on both of those indicators in the distribution segment. Market conditions in Q2 remained tough, significantly hampered our comparables. I will focus now on walking through the key impact factor on comparables, as we already discussed the one-offs. Electricity price dropped by 14 zloty, realized electricity price in PGE, leading to a loss of earnings of slightly above 170 million. Lower production added another 70 million to that. Our supply business is also severely under pressure, margins being squeezed by growing competition and burden from the support schemes, both the cogeneration support scheme that was reintroduced, Marek mentioned, and also a growing burden on renewables support from the green certificates. On renewables generation front, roughly 40 million EBITDA loss was caused by adverse hydro conditions. Weather was not supporting our renewables generation, and that loss of production will most probably not be restored in the second half of the year. As mentioned earlier, hardcore production economics improved. We produced 16% more of hardcore output with almost same cost as prices were down by 7%. Out of our 1.4 billion recurring EBITDA, 45% was delivered by conventional generation segment. That is down on comparable basis by 1/3, with the key impacts we already discussed. So dropping prices of electricity, 170 million negative impact, and lower volume of production, another roughly 70-80 million, luckily, impact on the conventional generation segment. Distribution continues to perform as planned, adding 40+% of our EBITDA. Our volumes in distribution are slightly up, as Marek showed, 2% up. There is also a tariff increase. However, that is mostly being transferred to the transmission system operator. So as such, with the return on regulated assets being down this year, we need to add to the results with additional efficiency measures to keep our results flat to last year. Our supply and wholesales business together show a decline in retail margins. The margin erosion can be seen, and that is also a result of actions taken in last year's. We expect, I will give you an outlook later on with finalizing our presentation, but we expect that to continue till the end of the year. Renewables grew high single digit as we added capacity in wind farms, but that was hampered, as said, with adverse hydro conditions and lower production volumes on water. In the first half of the year, the group continues the investment efforts. Our capex in the first half of the year came to 2.2 billion. 75%, roughly 3/4 of our capex, was being dedicated to modernizations and maintenance of our existing fleet that is expected to add on to efficiencies and add on capacity and better use of assets in the future. Roughly 20%, 22% in the second quarter of our capex effort is being flown into distribution. That is being pretty much almost immediately remunerated with the increased regulated asset base and return on that. And distribution is more heavy on capex with the second half of the year, usually. Our renewables investment in the first half of the year was 155 million, when we also added Wojciechowo wind farm to our fleet, and we have pretty much most of our capex already decided or even procured for wind farms generation. As we announced the strategy, we were also discussing the financing of our capex. Roughly 50 billion is to be invested until 2020. That requires PGE to enter the debt market, both with banks and investors in the bond market. Using the extraordinarily good market conditions in the last months, we decided to quickly enter the international bond market. With that, we successfully issued 2 issuances of Eurobonds with the framework of our 2 billion Eurobond program. One being a public offering of 500 million that we pretty widely discussed already. But just to underline, a 5 years Eurobonds issuance through our subsidiary established in Sweden, PGE Sweden, with a, let's say, great Yeah, great is a good one. With great yield of 1.625, that is setting a great benchmark for our future needs as well. We followed that with a private placement of longer tenure of 15 years. That was the size of 138 million euro, and with a yield of 3%. Just to underline that PGE is having a centralized financing model for its CapEx program. PGE is sourcing funds from banks and investors and then distributing those to the subsidiaries according to CapEx needs. I will hand over to Marek as we are going to discuss future developments and what we expect to happen in the next half of the year.
Exactly, thank you very much, Magda. However, it is always useful, I think, to look back what happened, just to know, to learn the lesson, why some things happened and why some did not. It's equally worth looking ahead on developments awaiting the sector and awaiting the PGE, we believe, in the coming months. I structured my presentation, or rather focused my presentation on 4 items, as you may see on the slide. So at first, electricity market as a whole. What we believe is the most important, what we believe are the most important factors that we have to take into consideration in the coming months, in the coming half of this year. First of all, I already mentioned briefly that topic, operational reserve mechanism. You know that TSO has published recently its proposal to reduce actually the price of the operational capacity reserve. The only reason it is readable from the documents published by the TSO is that the budget allocated within the existing tariff, the tariff of the TSO for this year, has ended up basically, and there is no more money that TSO feels to be authorized by the regulator to spend on buying the operational capacity reserve from the market. We are within the period of the public consultation of that TSO's proposal, and there is nothing new. This is not a mystery that as a whole sector probably, not probably, but for sure, the whole sector has given its opinion in a negative way about that proposal. This is also a signal that is confirming what I told you at the beginning of this year, that when we entered, when the market entered into having this new mechanism, I mean operational capacity reserve, this was a kind of a testing how big the budget for this should be, and the risk that the budget may be limited, not enough from the market perspective, was calculated. So we don't believe, of course this is up to the regulator, independent, but we don't estimate that the regulator could adopt that proposal, rather change the budget, I mean increase the budget for the next year for that operational capacity reserve. This is what we expect basically. Of course, this is our estimation. Don't read me as I am impacting anyone's decision, including the regulator. In terms of the cross-border exchange and the price formation, Poland has become net importer from being exporter, net exporter, sorry. Tricky words, from being net exporter during the last year. We are not surprised by that fact. We, let's say, incorporated such a development of the situation on the market in our assumptions, in our investment assumptions, basically, and in our long-term strategy. In terms of the level of the consumption of electricity, already slightly mentioned that the dynamics is catching up with the regular numbers, we believe that at the end of the year, the consumption should be slightly higher than it was the last year. Slightly, we don't expect any huge increase, but we never assumed that dynamics of the electricity consumption should suddenly be skyrocketing. In terms of carbon allowances, this is the second item I'd like to draw your and mine attention as well. We published our strategy with a horizon reaching 2020. So briefly, within that perspective, we don't expect anything surprising, anything wrong, anything deteriorating our business in this strategy. Despite of the discussion on the future shape of the European climate policy, which, just to remind you, is about the period after 2020. They're setting up the new targets by 2030. So today, the price of the CO2 allowances are still within the same corridor between something like 5 and 7 euro per ton of the CO2. We don't expect any major changes. As I said, despite of the fact of the discussion, which we cannot, we don't know the final result of the discussion on the European level, what the final outcome of the discussion on the future European climate policy might be. Except for the one fact that we believe that Europe is unlikely to give up with the ambitious approach to the climate protection. Okay. But in terms of the prices, we don't expect anything wrong. Model of the trading, basically trading. Yes, we are aware that we also said it clearly, explicitly in the mid-May when we published our strategy. We are fully aware that the liberalization of the retail market will have an effect of the erosion of the margins that we may earn on the retail supply. And in a consequence, we started a couple of months ago the strategic project within the company about update of our strategy of trading. And the project is on advanced phase. We are aware that this is a challenging market environment we have to face. So we continue our intensive works on reshaping our trading strategy. And the fuel situation. We have a hard coal supply secured from the local mining companies. We want to continue that. As it was mentioned, we perform pretty well. In terms of the gas-fired CHP units, we expect that CHP units will resume operations starting from the autumn heating season. But as I said, the restored support scheme for the CHPs reaches only 2018. This is rather short-term perspective, not a long-run perspective. So still any new decisions, investment decisions, it has an obvious impact on the potential investment decisions within that field of the energy market. Current economics of the biomass allows us to increase a production in a coal combustion, which means that we may earn more, basically saying, compared to the situation when no burning the biomass together with the coal. Will the situation continue or not, we'll see, but we are ready from the technical point of view and contractual point of view to enter into such an operation, just to burn more biomass. So I could say we are ready to respond quickly to the changing economic environment in terms of the prices of the biomass and the prices of the of the electricity on both on the wholesale and the retail market. So that's all we believe. What I would like to say to you, that we believe that is the most important factor, and our perspective on how the electricity market here in Poland and in Europe, I mean energy climate policy, may evolve in the coming months. So I will give back the floor to Magda.
Not only the market we expect to change within the next coming months, Marek just explained. We also expect, or not only expect, we are planning some changes in the operations of our group. Those are focused to foster our operations and to prepare the group to deliver the largest CapEx program of the history of the group. 4 key pillars of those operational improvement when it comes to support functions and processes. One, we are right now in the process of creating a single tax group of PGE that is focused on lowering the tax burden, lowering the risk of transfer prices, and also lowering CapEx, and will constitute, once established, the largest tax group in Poland. And we expect that to happen on the 1st of January 2015. Another important project, especially with the background of our large CapEx program, is cash management, cash pooling, and better utilization of working capital management processes. We are currently in the process of implementation of a group cash management program that will also include a zero balancing cash pool for all key entities of the group that will provide for better liquidity management, better forecasting, more accurate forecasting of cash needs of working capital financing. That will also let us decrease bank fees and decrease cost of capital on the consolidated level of the group. 2 more projects, more focused on support function. One is consolidation of accounting and payroll services, very much linked to implementation of a single ERP software within the group. With the SAP implementation, SAP is our ERP base. With the SAP implementation, we are pretty much advanced with a majority of entities already working on SAP or just joining, and with the scope of ERP covering accounting, payroll, HR management, asset management, and sourcing. And to fully utilize on that ERP implementation, we are also consolidating processes of accounting and payroll processing that we expect to be kicked off in January 2015. However, all of the process redesign has already been completed. And it's time for the Outlook update. On the back of the presented results and what we were just discussing about the regulatory environment and market scenarios, we also updated our Outlook. Our conventional generation outlook was revised with the positive impact of LTC's compensations covering for or compensating for weakened market impacts. Low electricity prices will continue to offset the favorable developments of LTCs and CO2s. However, we expect the segment to grow in 2014 as compared to 2013. We also expect further efficiencies to support results in the segment. As expected at the beginning of the fiscal, wholesales and supply suffer from deteriorating margins and reintroduction of cogeneration, and we expect the segment to be lower than last year's. Distribution and renewables are expected to be flat. The first one impacted by lower return on assets that will need to be offset with additional volumes and cost savings in the segment. The latter, renewables, was hit by adverse weather conditions and lower water production, so additional volumes on wind generation will not cover for that. We expect the segment to be flat. CapEx is progressing on track as we keep our previous outlook with regard to CapEx. And with that, ladies and gentlemen, I will be concluding our presentation. PGE's first half of 2014 results are a good reflection of our strategic efforts, our strategic priorities. Navigating through this difficult regulatory environment takes a lot of effort, and the market conditions are difficult, will remain difficult until end of the year. We will keep focus on efficiency measures, on development of the group, on streamlining operations, preparing for future growth, with CapEx now being focused on modernizations and maintenance that will be paying off with additional efficiencies in the future as well. With this, I will hand over to Kuba to open the Q&A session. Thank you.
I said the Q&A session is yours actually, so we'll be handing over to you here in Warsaw first. One remark at the beginning, if you could please ask no more than 2 questions at a time. That's for the sake of us answering the questions and for the sake of comfort of our internet viewers to follow the presentation. As usual, our internet audience can ask questions. I'll read them out. So the floor is yours.
My question refers to your earnings in the supply division, because this is something which surprised me negatively. Can you elaborate a bit more about the reason? Was it about that you were just not able to increase prices during the quarter? And if it was the case, what's going to be in the third and fourth quarter this year? Are you able to pass higher cost of certification to clients or not? So many other questions.
With the supply division, we, as usually, we recommend to read those together with wholesale division's results, as part of the retail margin is also shown in the wholesale segment. However, 2 most important factors affecting supply division, both pretty much equally in the first half of the year. One is certificates and support for renewables and cogeneration. That is roughly 235 million of negative impact. The burden on green certificates increased, so our obligation to redeem certificates is increased, and yellow and red certificates were reintroduced beginning of May. That was not existent last year, and that was also not included in the price formulas of certain groups of customers, thus impacting profitability. Secondly, the margin squeeze is related to results on sales of electricity. So with increasing competition, we were also communicating there is a pressure on sales prices and as such pressure on margin profitability.
So the second quarter profitability of supply and wholesale, a proxy of what we should expect in the remainder of this year?
We expect the pressure to continue.
Michał Peskinski from JP Morgan. Maybe continuing on the supply division, what is your strategy in this segment? I mean, it looks like you're winning market shares quite aggressively. How long could this profitability impact last from the margin side? So what's the profitability outlook in the next few years, apart from the next few quarters? And question number 2 would be on the realized power price outlook in generation for next year. Shall we assume the year-to-date average on the 2015 contract as a good proxy for your realization? How would you guide us in this respect?
Actually, if I answered precisely your question, I will disclose, let's say, and the strategy that we are planning to introduce. What I said, yes, we have a strategic project. I may only repeat. We concentrate on updating our trading strategy in order to respond to the demanding challenging market conditions that we see. You mean volume? I could say volume-driven strategy. I could say more balanced, because we would like to equally concentrate on profitability. I mean, the margins are also in the horizon of our interest, if I may call it like that.
Sorry, could you please repeat the last sentence?
Yes, because you said your opinion on the existing strategy, trading strategy of PGE, that the strategy was volume driven. If I could just collect as much customers as is possible, we would like to add. We plan to add a component of the profitability. I mean, the margin should also be taken into account, not only the volume. Okay.
So some improvement from 2015.
Exactly, that's what we do.
And on the power price realization in generation segment, so what's the outlook for 2015, if you could share with us?
I think that, let's say,
we were reporting outlooks of 15 to 20 zloty per megawatt hour down versus last year, and we keep the outlook.
15 to 20 zloty versus 2014.
Versus last year's.
But I'm asking about the outlook for 2015 versus 2014.
We are expecting growth of prices of electricity that can be already seen in the market, in the contracted volumes of electricity. Our price assumptions that we were using for investment projects and communicated with Apollo project remain valid, so to say.
So we expect that the wholesale prices of electricity will continue to grow in a moderate way, as we assumed at the beginning of the year. They will continue to grow, as they did during the last months.
So what range of potential expectations could you give us for 2015?
I would rather put this question to the next presentations we will be welcoming you with, giving outlooks for the next quarter.
Okay, thank you.
Thank you.
Hello, it's Piotr Dzięciołowski from Citibank. I have two questions really. One, have you changed any change in the behavior of the transmission operator this year versus last year? There's speculation in the market that it changed the way it operates interconnectors, changed the way it contracts power on the balancing market versus intraday market, and that's part of the reason for the premium of Polish base load. So that would be the first question. And second question I have regarding slide number 10. There is a number of employees in this chart. I wanted to understand where this figure will be, the 40,000 in, let's say, 5 years from here, 3 years from here.
Well, trying to answer your question, I don't know how to answer because I'm not the addressee of this question. Probably you should ask this question to the TSO because I'm not in a position to answer how the TSO behaves. But I don't suspect anything suspicious, as you're suggesting.
Well, you're trading power, so your traders contract power on the daily basis, including balancing and day-ahead market. So I wanted to maybe how much of trading that was normally distributed between balancing and day-ahead, how this changed, and do you also try to say you're not watching the cross-border when you trade power in Poland?
No. I'm not going to say I'm very far from saying that we are not watching the cross-border transactions. No, absolutely not.
I ask you, have you as PGE changed how the system works versus last year? Not if transmission operator changed it. So I just wanted to understand what's your interpretation of a spike? Is it just purely operational reserve, or there has been some other, something going on with the interconnectors?
Okay, now I understood the essence of your question. I would allocate, let's say, I think this is operational capacity reserve effects. When we introduced that, market has changed according to the assumptions, I would say. Why? But of course, why the budget was not enough, I'm not in a position to say why. Of course, maybe I'm not. I would like to be very precise, because this is some shortcut that I used. Budget is not ended up yet, but the TSO estimates that the existing budget for the operational capacity reserve may be not enough by the end of this year. That's why he reacts by publishing the proposal to the regulatory office to change the price of the capacity reserve mechanism, basically to decrease that price by the end of this year. The question what will happen during the next year or for the next year is still open and unknown. But as I said, we expect that the budget will be increased, but within the next tariff of the TSO. I don't see any critical elements within the system, but operational capacity reserve mechanism that could have an impact on the market. Okay, this is the only way I can answer your question. We are not, as a PGE, we are not the principal beneficient of this mechanism. I mean, we are not directly paid. Of course, we are, but we are not the main beneficient of that, of the budget of that mechanism. Yes, we are indirect beneficient. The wholesale prices are going up because of that mechanism is working. Okay. And well, that's it.
Okay, and regarding the slide number 10, my second question, shall we extrapolate this trend of 11% decline, or what's your view on this subject?
I suggest not to extrapolate to the very far future, because then most probably only a couple of employees would be left. We will be definitely working on new measures of efficiency that includes headcount reductions. But one of the programs that we already communicated that will be impacting conventional generation division is the voluntary leave program being realized this year. Those leaves will be still recorded in the next quarters as those were phased during the year. So we still do not see in the end of June results the full effect of the voluntary leave program in the conventional generation segment. Our key concern is proper staffing, not the tightest staffing. We will be taking measures in other divisions, but I would rather expect the phase of those leaves to be more moderate than it was here, as the low-hanging fruits have already been grasped. Would you like to add anything, Mark?
I think that's fair enough.
Thank you very much.
Michał Patera, UBS. I have a question regarding LTC compensations. This becomes a material non-cash item. When do you expect to see, and in what amount, the cash actually landing in PGE?
Okay, that's a tricky question, as the long-term compensations we account for in our books is based on accounting measures, so does not directly link to cash, but in total for full compensations of the period, and we will be finalizing our compensations in 2017, revenues will equal cash received from the regulatory office. So when you take the full compensations for 2008 until 2017, your revenues will equal cash. However, cash received from the operator is not equal to revenues on annual basis.
So could you give us an estimate, of the difference between what's accounted and how much cash was received?
That can be seen in our financial reports in as payables, receivables from the long-term contracts compensations. And we expect that to finalize in 2017.
My question is, maybe that doesn't concern PGE, but it may turn out that there will be like a large cash component 2017. Do you know how that is supposed to be funded?
By the regulatory office, yes. That's what you mean.
There is a mechanism described in LTC law, right? There's a transitional fee. If this scenario will happen, why not? Then the regulatory office will have to increase or allow for the increase of that transitional fee, opłata przejściowa, which is a component of the distribution and TSO also, but mainly distribution tariff. There is no other way to collect the money from the market.
But also worth noting is that there is a cap defined in this act of law. So it's not really a tricky question to the regulatory office. The regulatory office is planning for those compensations. They are fully aware what each of the generators will be receiving.
Thank you.
Andrzej Bernatowicz, Bosch. I would like to ask about your operating cash flow, because when we take EBITDA minus tax expense as a benchmark, we see that your operating cash flow is approximately 30% lower in second quarter. And could you explain why is that?
The results that drive operating cash flows is recurring EBITDA. So when adjusting, when seeing recurring EBITDA being down by 1/3, our operating cash flows adjusted for the prepayment for coal supplies is also down by 1/3. That goes in line.
Right, because it's adjusted EBITDA minus tax, and it's still. Yeah.
Exactly. The 1.5 billion of EBITDA components that are of one-off nature are non-cash items. So as such, they do not impact operating cash flows.
Thank you.
Let me ask a follow-up question. I just wanted to understand, are you going to consider reported net profit when deciding on 2014 dividends, or will you look at the cash flow you generate? Because in the past there was a different case, so clearly dividend expectation is important for the market.
With the recent strategy update, we also confirmed our dividend policy, and that states very clearly that dividend is going to be suggested by the management based on consolidated net profits.
Sure, including one-offs.
Consolidated reported net profits.
Since we have a minute for our internet audience, we have a question from Igor Kozmin from Morgan Stanley. Could you provide any savings impact guidance for further years?
For which period? Savings for current year.
For further years.
Further years. With the recent strategy again, we committed ourselves to deliver 1.5 billion of sustainable savings post 2017. So until the end of 2016, 500 million of that was already delivered with the program up to 2014, and we are continuing within the next 3 years to deliver 1 billion. As such, I guess this is quite a convenient guidance.
Nothing has changed since that time as we published our strategy, so we are on the path, as I said, in terms of our savings program.
Okay, so it seems that we already addressed your questions in the presentation or in the Q&A. So thank you very much for coming here. We will be glad to see you again on November 13 when we will be disclosing Q3 results. And thank you again for coming.
Thanks a lot.
Thanks. Dziękuję bardzo Państwu.